G'day everyone, welcome to this update for global equities, and the question posed whether this is the time to be selling up and going away, as the old saying goes, but I don't think so, and I'm going to provide some details on why I think that's the case. So let's jump into it. It was a pretty volatile week last week. We're right in the middle of American earnings reporting season. Some stocks have done exceedingly well, quite a lot haven't. So it's a fairly volatile time. We've had currency movements all over the place. So fairly pivotal week last week. The S&P ended up down by 10 points, but it was really quite a wild ride. And Wall Street analysts certainly aren't helping because they're just looking so short term that they're flip-flopping all over the place on the results that are coming out, and that's really confusing investors. So not at all helpful from that side of things. And hopefully Warren Buffett steps up to the plate next week to talk about his company Berkshire Hathaway, and he always has a refreshingly calm outlook for the longer term, and hopefully that'll get people a bit refocused on some of the important fundamentals, rather than listening to some of these ratbag Wall Street analysts that are looking 5 minutes ahead of themselves. Now, there's no question that out of the American earnings season, that profit growth is under pressure. Expectations were wound right back. There's still a lot of companies are beating expectations, but if you look at their profit growth, it's pretty slim. So there's no question that that big profit growth we've seen over the last 2 to 3 years in America is slowing for most stocks. And there was some very poor results came out from some of the energy companies, and also some of the high-flying stocks like LinkedIn. So there's no question that there are stocks that are going to struggle in America. But the best stocks, the ones that I deal in almost exclusively, are still performing wonderfully. And we saw about 5 really outstanding results last week for those stocks. And of course, members of Specialist Share Education know exactly what stocks I'm talking about. Very, very pleasing performance. And we haven't seen the response in the share price as yet. I think that's still to come. Now, the small cap indices were a little bit weaker, so that bears watching. Regular viewers of this video will know that the Nasdaq and the Russell 2000 index have been leading the way. So that's just a little bit of a maybe early warning sign to keep an eye on. Just quickly, the Aussie stocks, our index was down 120 points for the week, and all I can say to that is it's about time, because the banks were at silly valuations and had to come off at some stage. So they were the hardest hit sector. They led the way down. And we also saw some strength in the Aussie dollar, which was really more about the US dollar weakened to a degree, and also the short-term surge in iron ore price, in the oil price, which really do look completely unsustainable to me. So let's have a look at a few charts. We'll start with the S&P 500. This is big picture. This is a monthly chart. So the dip here is March 2009. So that's the end of the GFC crash. And you can see over the last couple of years, the last time we had any sort of meaningful dip in the US indices was in 2011, when the market went down for about 3 or 4 months in succession. But since then, it's been a tremendously strong trend. There was a bit of a blip in October of 2014, but since then, the US market just keeps marching on. If we look at it on a daily basis, you can see that recently the market has been just going sideways, or the index has been going sideways, and that reflects this slowdown in American profit growth. Profits are still growing, but they're growing at a slower rate in general. Now, normally the market index, you would expect under such conditions, would have gone into a decline, but because of what central banks are doing, markets are still holding up, because there's really nowhere else to go, and that's really the bottom line for stock markets. There's nowhere else for investors to put their money to get a decent return. Now, looking at at the NASDAQ index, you can see it's still going along quite well, so that's encouraging. Technology still doing quite well. But if we go to the Russell 2000 small caps, you can see, and it's nothing dramatic, but certainly there was a big fall on Thursday before we got that reversal on Friday. So it just is something just to keep a bit of an eye on. At this stage, it's really nothing really out of the box, but just a slight change in trend. Now turning to the Australian indices, this is the ASX 200. So 6,000 points just through there is proving to be an impenetrable ceiling at the moment, and so it should be, because there's just no value up there in the Australian stock market. So we're back down to the bottom of the range. Given what happened in the US on Friday night, we should see the Australian index move higher, but there's a big divergence all of a sudden between commodity stocks and banking stocks. There's the materials index, so that largely reflects BHP and Rio. And you can see that over the last few months, it's been largely sideways, and it was actually a little bit higher during last week. However, if we go to the banking index, you can see a substantial decline on both Wednesday and Thursday in the banking index, and it's broken through these lows here. So I fully expect to see the banking index a little bit lower yet, but it is short-term oversold. We might get a bit of a bounce and then a further decline. So if you have a substantial exposure to bank stocks, I don't think anything dramatic is going to happen, but I just don't see that you're going to be able to make a good reward for risk out of the Australian banks. Now, there's some better value emerging in Australia. There are some really good stocks that have been very much overvalued for a long period of time, and they're not necessarily great value, but they're certainly better value than they were. But you must stay with the cream in the most highly reliable growth sectors there are. Now, again, members know very, very clearly what sectors I'm talking about and what stocks I'm talking about. If you don't know what these stocks are and what the sectors are, then the Australian market is a very, very risky market. And if you're going to continue to play in it, then you need to find out what those sectors are and stocks are pretty quickly. Turning to commodities, gold was flat at 1180. It was a bit volatile, but ended up where it started the week. And there's just a frustrating lack of net movement in the precious metals market. So my advice is this is not a good reward for risk. Just stay out of the gold market for the time being. Now, copper did make a very strong move up to 289, and that's a good sign because it's supporting the global growth story. If growth really was slowing down, as some people are suggesting is going to happen because of China, then I can assure you copper would not be trending up as it is, and we'll see that chart in just a minute. Now, crude oil continues to firm. I think this is just hedge funds who had been significantly short crude oil have been covering their short positions. So there's been a bit of a short-term surge. But if supply and demand meets, I should say if supply and demand means anything, then the bounces that we've seen in iron ore in particular have really got to reverse and go down again. Oil, we've probably seen the bottom in oil, but it's not to say that oil can't move lower again, and I really don't see it moving much higher than where it is now. It's hard to see oil being able to sustain above $60 a barrel. There's the copper chart, a lot of improvement in the last week, and you can see it really has moved into quite a significant uptrend again. So that's a good sign for global growth. Let's just have a quick look at the gold chart, first of all. That's the US dollar value of gold on a daily basis. So you can see we had a couple of strong days up and then 3 days down. If we look at it on a wider weekly view, you can see we're still stuck in this wedge. It's a wedge which technically, if you wanted to toss a coin, you would have to say is going to break to the downside because we've got lower highs all the way through here. And and we've been unable to gain any momentum off this base that would normally provide a good turning point for gold. So gold looking pretty shaky to my way of thinking, and if it does break these recent lows, you're going to get a lot of technical selling come in, and therefore I would think there's two objectives. One is this long-term inclined trend line, which comes in around about 1,070 at the moment, and then we've also got a support line here which picks up some previous support peaks at just over $1,000. So we could get a very sharp $100 to $200 move in gold if that support breaks. So that's why I don't think the risks are worth the effort at the moment. So overall, the strategic approach, I still stay with this theme. I think this is close to an ideal environment with interest rates staying ultra low for an extended period of time, and central bank stimulus is massive in Europe and Japan, and even more than that, I don't believe they have any choice. I think they are stuck in that mode for many years to come. So is it time to sell in May and go away? If you know where to go and what stocks to buy and what represents value and how to technically get in and manage, then my answer is definitely not. I think there are tremendous opportunities over the next 3 or 4 months, but there is also a lot of danger. And if you don't really know what you're doing, this market is going to get, I think, fairly risky for inexperienced players over the next 3 or 4 months. Most stocks deserve to be flat or lower, both in America and Australia, but central banks continue to be very supportive of stock markets in general. So therefore, I'm not getting too bearish on the market, but certainly some stocks will be lower. I still think the main indices may be broadly sideways but volatile until October, and great stocks will outperform, but many will not, and that's the risk. Diversification outside Australia, I think, is an absolute given. The US still offers opportunities, but there are also opportunities elsewhere around the world, as members know. So for anyone that who's not a member who wants more information about what I do and how I may be able to assist you, there's my email address and further information on our website. That's it for this week. I think another interesting week coming up, and talk to you again shortly. Cheers.